Welcome to the deep dive. Today, we are really wading into a fascinating strategic battlefield. It's all about how basically every digital product, every marketing campaign, even presentations get made these days.
Yeah, we're talking about the creative tech triumvirate, these three titans, Figma, Adobe, and Canva, who are genuinely reshaping how creative work gets done.
It sounds simple, maybe just three companies, but it's way more complex than that, isn't it?
Oh, absolutely. This isn't just comparing software, it's about understanding how they've sliced up the entire creative market. You've got Adobe, sort of the established pro standard, mainly desktop
Well,
historically.
the old guard almost.
Then there's Figma, the cloud native disruptor, all about collaboration. And finally, Canva, the mass market player, bringing design to, well, everyone.
That's a great way to put it. So our mission today is to really dig into their core strengths, the competitive moats, how they actually make money.
And critically, how they're positioning themselves for what's next, especially with AI looming over everything, potentially changing the whole creative process.
Exactly. The competition here is just
Right.
huge. You've got Adobe, the incumbent, defining professional work for decades.
But facing this pincer movement, like you said,
Yeah.
Figma hitting them on the product design collaboration side.
And Canva scooping up, hundreds of millions of users at the simpler end. It's quite the dynamic.
It really is a perfect example of how specializing lets you scale massively. But now their orbits are starting to intersect, and that's creating some real competitive heat.
Okay, let's unpack these players, starting with the one that really shook things up, Figma. You called them the Collaboration Command Center. What does that actually mean for someone using it day to day? What's their core product identity?
Right. Figma's identity comes from being truly cloud native. It's a multiplayer editor from the ground up. So forget downloading stuff, forget emailing files back and forth.
Yeah, the old final v2.psd nightmare.
Exactly. Figma lives in the browser, real-time collaboration.
Yeah.
But it's more than just the design tool itself. It's really a platform with, let's say, three key parts.
Yeah.
There's the core design and prototyping editor everyone knows.
Wow.
Then there's FigJam, which is their whiteboarding tool for brainstorming, ideation. And then, maybe the most strategic piece right now, dev mode.
Dev mode, okay. I've seen that mentioned a lot as a huge growth lever for them. Can you break down what it is and why it's such a big deal compared to, say, traditional tools?
Sure. Dev mode is Figma's attempt to bridge that gap, that often painful gap, between design and engineering. Traditionally, a designer finishes a mock-up, throws it over the wall to an engineer.
And the engineer has to guess sizes, colors, fonts.
Precisely. Manually inspecting everything, trying to translate visuals into code. Dev mode aims to automate a lot of that. It generates production-ready code snippets, CSS, iOS, Android, and can even sync with tools like GitHub.
Wow, okay. So the problem it solves isn't just designers working together better.
No. It's tackling that massive friction point in the whole product development cycle. The errors, the wasted time, the back and forth during that design to dev handoff, that's huge for UX and product teams.
And that focus immediately tells you who their main customer is. It's not just a solo graphic designer working on a poster.
Not at all. Their sweet spot is organizational teams. It ranges from individual UX folks all the way up to huge enterprise product and engineering departments.
Right.
And this is key. The people making the buying decisions have changed. It used to be maybe just the head of design.
But now,
Because Figma touches the entire development workflow impacting engineering sprints, needing IT integration, security reviews, the head of product, and even IT and security leaders are crucial decision makers.
that deep integration across functions, that sounds like the real competitive moat. The switching cost must be massive for big companies.
It is. And what's really impressive is their product-led growth, that PLG model, and the network effects it creates. Once a team starts using Figma, yeah, the collaboration features are sticky.
But there's more to it.
Oh, yeah. The real lock-in comes from the ecosystem. The community plugins that automate tasks, the shared design systems, the templates.
Yeah.
Pulling a big team out of that, it's incredibly disruptive.
You'd basically stop product development for months trying to switch.
Pretty much. And that stat we saw really hammers this home. Product managers and engineers now account for something like 67% of Figma's revenue.
67%. So it's not just designers anymore.
Not even close. They didn't just sell a better drawing tool. They sold operational infrastructure for shipping digital products.
That's a fundamental shift.
It really is. It means when a company grows its engineering team, which often happens faster than design team growth, Figma benefits automatically.
Mm.
Their competition isn't just about features against Adobe XD or Sketch anymore. It's about owning that whole operational workflow.
Okay, let's shift gears to the established giant, Adobe, the professional juggernaut. If Figma is about focus, Adobe seems to be about, well, everything.
Breadth, exactly. Adobe's identity is diversification and professional-grade tools across multiple domains. It's not just one cloud, it's three huge ones.
Right, everyone knows Creative Cloud. Photoshop,
Yeah.
Illustrator, Premiere Pro, the standards for content creation.
Yep. Then you have Document Cloud Acrobat, sign managing all those crucial PDF workflows and e-signatures, super important for businesses.
And the third one, Experience Cloud. This one might be less familiar to some listeners. What exactly is that?
Experience Cloud is Adobe's massive bet on MarTech, marketing technology. It's a whole suite of tools for large enterprises like analytics, content management systems, personalization engines, customer journey mapping.
So, tools for managing how large companies interact with their customers online.
Precisely. It's about making sure all the amazing content created in Creative Cloud actually gets delivered effectively, managed efficiently, and measured accurately across huge, complex customer experiences, mostly targeted at the Fortune 500 level.
Got it. So, while Figma might own the workflow for building a tech product,
Adobe aims to own the entire pipeline for creating, managing, and delivering content and customer experiences for massive global organizations. It's a totally different scale.
and their customer base reflects that scale.
Absolutely. From individual freelance photographers all the way up to the biggest multinational corporations needing complex integrated solutions.
So, what's Adobe's moat? How do they defend this empire?
It rests on, I'd say, four main pillars. First, just undeniable brand recognition and decades of built-up trust in the professional space.
Sure, everyone knows Photoshop.
Second, the sheer size of their installed base. People learn Adobe tools, entire industries run on them. That creates inertia. Third, the integration between their clouds, creative, document, experience, makes the whole package very sticky.
And the fourth?
Those big established enterprise contracts, we're talking multi-year, multi-million-dollar deals that span multiple departments.
That enterprise contract piece sounds crucial for stability. It locks customers in, right?
Definitely. It dramatically increases the friction of switching. Moving a large organization off the Adobe ecosystem isn't just swapping out one tool. It means retraining potentially thousands of people, breaking ingrained workflows, dealing with complex integrations. They really occupy that established high-end enterprise market. They are still the leader in pro creative software.
Okay, and the third player, rounding out the triumvirate, Canva.
Yeah.
The democratizer of design. Their philosophy seems completely different again.
Completely. Canva is all about the mass market, the largest segment by sheer user numbers. Their identity is built on being friendly, accessible, drag and drop, simple. Presentations, social media graphics, simple videos, basic websites.
Stuff anyone might need to make quickly.
Exactly. And now they're adding their Magic Studio AI tools to make that creation process even faster and easier.
So the core problem they solve is basically lowering the bar, making design accessible to non-designers. You don't need years of training.
That's the heart of it, democratization. And that accessibility fuels incredible scale. Their customers are individuals, small businesses, students, teachers. Increasingly, even teams within large enterprises needing quick, branded internal comms or marketing assets.
And their moat isn't complexity, it's...
Scale and simplicity. Hundreds of millions of users, an interface that's incredibly easy to pick up, a vast library of templates, that's their defense.
So if Adobe has the pro skills and Figma has the collaborative workflow...
Canva owns the casual user and the need for speed and ease. They compete down at the simpler end with things like Adobe Express or maybe tools from Microsoft or Google.
You're right.
But Canva's user acquisition funnel is just unparalleled. They cast an incredibly wide net. And crucially, their brand is built around design for everyone. Adobe Express, while capable, can sometimes feel like an elite version of a pro tool. Canva owns that perception of accessibility. Okay, so how do these three actually make money? The common thread is, unsurprisingly, subscriptions. Recurring revenue is king.
But the way they get those subscriptions and grow them is totally different, tailored to their markets. Let's break down those engines. Figma first, you mentioned their viral collaboration aspect.
Yeah, Figma uses a very effective land and expand strategy. It starts with a generous freemium offering. Individuals or small teams can start using it for free.
Get them hooked.
Exactly. Then, as teams grow and need more collaboration features, security, admin controls, they hit triggers that push them towards Paid Plans Pro organization or the big enterprise contracts.
And then they expand within those accounts.
Yes, that's the expand part. They increase the average revenue per account, or ARPA, by selling more seats as the team grows, but also by upselling premium features, governance tools for IT, and add-ons like the paid tiers for FigJam.
So that high net dollar retention you talked about earlier, existing customers spending more over time, that's almost built in. If a company hires more engineers or PMs.
They need more Figma seats.
Exactly.
High NDR means growth happens somewhat automatically within your existing customer base. Figma scales alongside its customer success, particularly the growth of their product and engineering teams.
Adobe's engine feels different. They start bigger, right? Selling the whole package.
Generally, yes. Adobe often sells broader Creative Cloud or Document Cloud subscriptions directly, frequently, through those large, established enterprise deals we discussed.
And their growth comes from.
Going deeper. Getting customers to buy across their clouds, bundling Creative, Document, and Experience Cloud for maximum value and lock-in. And, very importantly now, monetizing new advanced features, especially their AI capabilities like Firefly, across the whole suite. That's key to keeping and growing revenue from their professional base.
Okay, and Canva's engine. It's
No.
all about that massive user base converting just a fraction of them.
It's pure volume economics almost. They have this enormous free user base, over 170 million active users, which is staggering. The strategy is converting even a small percentage of those free users to Paid Plans Pro for individuals, teams, or their growing enterprise offering. But they also expand revenue per user, ARPU, through other avenues.
Like what?
Things like Canva print services, selling premium stock content or templates from their marketplace, and charging for certain advanced AI features. That huge free base gives them a unique growth runway as long as they convert efficiently.
This comparison really highlights that cultural difference you alluded to earlier, the Microsoft Office versus Google Docs analogy for design tools.
It's such a perfect analogy for the shift Figma drove. Traditional Adobe workflows often meant downloading software, working locally, saving versions, Design 3, Final.ai.
We've all been there. Collaboration was painful. Sending files, managing feedback.
Total friction. Figma, like Google Docs, changed the game by making it real-time, browser-based. Multiple people, 5, 50, whatever, working in the same file simultaneously, seeing changes instantly.
That real-time aspect, that's the core innovation that powered their viral growth and stickiness, right? It just solved a massive pain point.
Absolutely. It fundamentally changed the workflow. And this has really long-term consequences. We're seeing a whole generation of designers coming out of school now who are Figma natives.
They learned design using collaborative browser-based tools.
Exactly. That's what they expect in the workplace, which means the demand for that collaborative model, and for Figma specifically, likely has a very long runway ahead of it.
Okay, let's dive into the financials a bit more. Looking at the health metrics, Figma shows some strong SaaS numbers, but also maybe some warning signs.
Yeah, Figma's gross margins are fantastic. Textbook SaaS, like 80–90%, really high. And they just hit their first profitable quarter, which is a big milestone, signals maturity. But the metric catching analysts' eyes is growth rate. They were growing at triple-digit percentages for a while, true hypergrowth. Recently, though, guidance has been softer, maybe settling into the 20–25% range. Still strong, but a definite slowdown from the peak, and maybe not what the initial high valuation baked in.
So how do they get back to satisfying those high expectations? What's the plan to reaccelerate?
It's about going deeper into existing accounts and expanding that TAM, driving seat growth within big enterprises, especially pushing dev mode adoption to monetize engineers. That's a huge potential user base.
Right, the 67% number again.
Exactly. And converting more of those non-designer users, the PMs, marketers, execs who need to view, comment, or approve designs into paid seats, they need to capture more value from the entire product team.
And Adobe, their financial story is less about hypergrowth and more about stability and cash generation.
That's right. Adobe's an established giant. The focus is on strong, predictable free cash flow, maintaining a healthy balance sheet that lets them invest heavily in R&D and make strategic acquisitions when needed.
Their growth drivers are more about integration then.
Primarily, pushing that cross-cloud adoption, getting enterprise customers to buy the whole suite, and, critically, successfully, integrating and monetizing Firefly AI across all their products to add value and justify premium pricing, especially for their core professional users.
And Canva, still private, but how does their financial picture look based on what we know? Built on volume, you said.
Reports suggest Canva is profitable and doesn't carry much debt, which is impressive given their scale. Their financial success hinges on two things: converting more of that massive free user pool into paying customers and successfully penetrating the enterprise market.
Convincing big companies that Canva is robust enough for their needs.
Exactly. Proving it's not just for social media posts, but can handle internal comms, marketing templates, etc. at scale. And, crucially, they need to manage the costs of AI effectively so it doesn't kill their margins as they scale. They have to prove that volume translates to profitable growth when they eventually IPO.
All right, let's talk risks. Every company has vulnerabilities. Figma, interestingly, despite being cloud native, seems to have a major dependency.
Yeah, it's a bit ironic. Their biggest strength, being built on the cloud, specifically AWS, is also a major liability. Their S1 filing revealed their single largest contractual obligation is a multi-year, multi-billion-dollar commitment to AWS for cloud hosting.
Multi-billion, wow.
Yeah, that creates a huge dependency on a single supplier, AWS, and exposes them to significant risk if cloud costs fluctuate, or, more worryingly, if their own growth slows down unexpectedly.
So if revenue growth dips, that massive fixed cost for AWS becomes a real drag on profits.
A huge drag. They basically have to keep growing fast to justify that level of spending. It makes their financial model quite sensitive to growth deceleration.
Okay, so Figma's dependency is external infrastructure cost. What about Adobe and Canva? What are their key dependencies or risks?
For Adobe, the dependency feels more internal. It's really about the successful execution and monetization of their own AI, primarily Firefly, across their complex product suite. They need to prove their proprietary AI provides real value and can fend off competitors, perhaps using more generic models. Their R&D muscle is key here.
In Canva.
Canva's dependencies are more external again, and really center on the economics of AI. They need access to affordable AI compute power, especially GPUs, given their scale. And they need solid, affordable content licensing deals to train their generative AI without running into huge IP or copyright problems down the line.
That brings us squarely to the AI integration challenge. Figma actually stated in their S1 filing that AI could potentially destroy their business model. That's pretty blunt.
Extremely blunt. You rarely see that level of transparency. It shows they recognize the existential threat. If AI gets good enough to generate polished, production-ready designs and code directly from a simple prompt, well, where does a collaborative design tool fit in?
Right. If the AI does the work, why do you need the tool for humans to collaborate on the work? So how are they planning to counter that? What does owning the workflow between humans and AI actually mean in practice?
Their strategy isn't necessarily to build the world's best image generator that's more Adobe's play with Firefly. Figma's goal is to become the essential command center for the entire product shipping process, whether humans or AI are doing the tasks.
Okay, how?
By integrating AI into their collaborative workflow at every stage. Think brainstorming with AI assistants in FigJam, using AI to generate design variations, or, crucially, using dev mode as the place where AI-generated code gets reviewed, tested, versioned, and ultimately integrated alongside human-written code.
So even if an engineer uses, say, GitHub Copilot or some other AI tool to write code.
That code still needs to be managed, validated against the design specs approved by the team,
Yeah.
and Figma wants their platform to be where all that coordination happens. They want to be the system of record, the control plane.
So they're positioning themselves as the indispensable layer between human intent and automated execution, managing the whole process.
Exactly. Making sure that whether it's human creativity or machine generation, the collaboration, the review cycles, the handoffs, the security checks, all that still runs through Figma. It's a bet on process ownership over just creation tools.
Adobe's approach with Firefly is different then, more focused on the content itself.
Yes, Adobe is leveraging its huge advantage. Vast libraries of high-quality, commercially safe training data. Firefly is designed to be woven directly into Photoshop, Illustrator, Premiere, etc., enhancing those tools and justifying premium subscriptions. It's a direct monetization play focused on empowering their existing professional user base with generative capabilities within the tools they already use.
Makes sense. And Canva's AI risk is primarily financial, you said. Margin pressure.
Mostly, yes. Running AI models at the scale of Canva's user base could be incredibly expensive, especially for complex generation tasks. There are the raw compute costs, the content licensing fees to avoid copyright issues, and the potential legal liability if their mass-market AI tools generate problematic content. All that could seriously squeeze the profitability that makes their model attractive, especially pre-IPO.
Interesting dynamics. Before we look at this from an investor's point of view, there was that note about Figma's management structure, specifically CEO Dylan Field's control.
Right, that's a classic Silicon Valley founder-led setup. Field retains a significant equity stake, around 11%, which aligns him with shareholders. But the key governance point is his voting control.
How does that work?
Through supervoting shares, usually Class B shares. While public investors get Class A shares with 1 vote each, Field's Class B shares likely carry 10 votes each or something similar. This gives him around 74% of the total voting power.
Meaning he effectively controls the company's direction, strategy, board appointments, everything, regardless of the public float.
Pretty much.
Yeah.
It ensures stability and allows for long-term vision, which many argue is crucial for disruptive companies. Think Meta, Google, etc. It insulates leadership from short-term market pressures.
And he has incentives to stay.
Oh, yes. The sources mentioned a potentially massive, multi-billion-dollar long-term incentive package tied to performance milestones post-IPO, designed to keep him leading the company and focused on execution for many years. It strongly aligns his personal fortune with creating long-term value.
Oh.
Okay, so if you're an investor looking at these three, they really fall onto a clear spectrum of risk versus reward.
Where does each one sit on that spectrum right now?
Adobe is definitely positioned as the safety play. Stable, predictable cash flows, strong market position. It's the dependable compounder, lower volatility, but maybe lower explosive upside.
Okay.
Figma is at the other end. It's the high-risk, high-reward bet. The potential upside is massive if they execute perfectly and capture that huge market, but the valuation makes it inherently risky. It offers the most asymmetry.
And Canva.
Canva sits somewhere in the middle. It's definitely a growth story, but its near-term fate is tied to a successful IPO. It's potentially faster growing than Adobe, but maybe less proven in the enterprise and facing those AI cost pressures we discussed. It's between Adobe's stability and Figma's hypergrowth gamble.
Let's dig into that Figma valuation. You called it an anomaly. The stock had a wild ride after the IPO, right? Soared, then crashed hard.
Yeah, it hit a peak around $140 a share, then plummeted over 60%, down to the mid-$50, a brutal drop.
What drove that crash? Just the growth slowdown meeting that sky-high valuation.
That was the main trigger. The core issue, the elephant in the room, is a valuation multiple. Figma has been trading at a price-to-sales ratio, PS, of around 30x.
30 times sales. How does that compare to peers?
It's incredibly high. The average for comparable SaaS companies is usually somewhere around 9x. Adobe is much lower, maybe 6.5x, Atlassian around 8.7x, so Figma is over 3 times higher than its peers.
Okay, that sounds precarious. How on earth do investors justify paying that kind of premium? Where's the margin of safety?
The justification isn't really based on current financials. It's a bet on the future and the nature of the market they're targeting. The argument is that the total addressable market, the TAM, for product design and collaboration is enormous, estimated at over $50 billion.
Right.
And the market isn't valuing Figma as just another creative tool provider. It's valuing it as infrastructure software, as the critical layer that enables modern cloud-native product development.
So the thesis is, Figma isn't just selling software licenses, it's embedding itself into the fundamental workflow of how companies build digital products, and that justifies an infrastructure-level multiple like Snowflake or Cloudflare might get.
Exactly. It's a bet on category dominance. If Figma becomes the default platform globally for designing and shipping digital products, maintains that high net dollar retention, and keeps expanding its reach into engineering teams, then maybe today's 30x PS multiple will look reasonable, even cheap in hindsight.
Big if, though.
Huge if. If they stumble, if growth slows more, if competition bites harder, the downside is clearly severe, as that 60% crash already showed us.
Okay, let's look at those future scenarios. Analysts project out to 2029. For Figma, the high-risk play, what does success look like in terms of numbers?
To hit their bull case valuation, think $35 to $45 billion market cap Figma needs to sustain incredibly high growth. We're talking a 35% to 40% compound annual growth rate, CAGR, in revenue for the next 5 years.
That's aggressive.
Extremely. It requires nailing the dev mode monetization, winning huge enterprise deals, and really becoming indispensable across product design and engineering globally. The bear case. Growth slows down significantly, maybe below 15%. Competition heats up. Those AWS costs become a burden.
Yeah.
Then the valuation could compress dramatically, maybe down to $8 or $9 billion.
Ouch. Okay, Canva, huge user base, but still private. What's their path post-IPO?
Canva's bull case also relies on maintaining very high growth similar to Figma's target, maybe 35–40% CAGR. They need to prove they can convert free users effectively and make serious inroads into the enterprise market. Convince large companies to adopt the Canva widely.
If they pull that off.
They could potentially command a $100 billion to $120 billion valuation after going public. Huge potential. The bear case risk is growth slowing below 20%, those AI costs really eating into margins, or maybe they just mispriced the IPO and the market reacts negatively to the profitability profile or enterprise traction. And Adobe, the steady giant, what's their trajectory look like? Much more moderate growth expected, maybe a mid-teens CAGR, say 12% to 14%. Their bull case isn't about hypergrowth. It's about successfully leveraging Firefly AI to deepen engagement and justify pricing power, continuing to win with cross-cloud bundles in the enterprise.
And that leads to
A potential market cap approaching $400 to $450 billion. Still significant growth for a company that size. The bear case is slower growth, maybe falling below 8%, perhaps due to AI competition impacting Creative Cloud more than expected, leading to multiple compression and flatter returns for investors.
Wow, okay, that was a really comprehensive deep dive into three incredibly influential companies, each dominating a different slice of the creative economy. Let's quickly recap the core essence of each before we wrap up. Their main strength, biggest growth driver, and top risk.
Sounds good. For Figma, core strength is that sticky collaboration-first workflow and the PLG engine. Top growth driver is definitely dev mode adoption and expanding into those non-designer enterprise seats. Main risk: growth slowing down while facing those huge cloud infrastructure cost commitments.
Got it, Adobe.
Adobe's strength is that deeply entrenched professional suite, the cross-cloud integration, and those massive enterprise contracts. Top growth drivers making Firefly AI a must-have value add across their clouds. Main risk is probably multiple compression if their organic growth rate looks too slow compared to the faster movers.
And
Canva's strength is that unbelievable scale, the massive free user funnel, and its dead simple UX. Top growth driver is converting that free base to paid and scaling up their enterprise presence. Main risk is definitely the financial side margin pressure from potentially high AI compute and content licensing costs.
So the big takeaway here feels like the market isn't really zero-sum, at least not yet. They've each carved out these really distinct, valuable niches.
Exactly. Adobe owns the high-end professional creation suite. Canva owns mass market simplicity and speed. And Figma owns that critical collaborative workflow for building products.
But the real battleground moving forward isn't just about who has the best features for one task.
It's about who controls the team's entire process. From the very first brainstorm in something like FigJam, through the design iterations, the coding, the testing, all the way to the final shipped product. Owning the workflow is the ultimate prize.
Which leads us perfectly to that final provocative thought for you, the listener, to chew on.
Right. If AI continues its rapid advance, if we reach a point where AI can generate truly production-ready code, complex designs, high-fidelity marketing assets, all from simple prompts, significantly reducing the need for hours of human execution.
Which of these three companies is best positioned to survive, maybe even thrive, in a world where the human creative executor becomes less central?
Is it Figma, focused on being the essential coordination layer between humans and AI, managing the process?
Is it Adobe, leveraging its vast proprietary data to sell the highest quality AI-generated final assets, owning the output?
Or is it Canva, focused on abstracting away all the complexity, making powerful creation trivially easy for everyone, owning simplicity at scale?
What does that potential shift away from human execution mean for the future of creative work itself? That's the deep dive for you to continue exploring.